All right. So what we're going to take a look at here is the merchandise and transactions. We're now going to look at from both sides of it. So we looked at it from one side, and now we're looking from both sides and what it means to both companies. So we have a sale here. So Scully Company sold, and this is what's happened here. This is the transaction. Scully Company sold merchandise on account for $7,500, and FOB shipping point and net 45. So notice it's 45 days. So for Scully Company, they have two transactions that's happened because they have the sale, and then we have to move our merchandise inventory into our cost of merchandise sold, because now we've sold it. So that's why they have the two transactions there. Where this side is they just received the merchandise, we have that, and we have a payment that we owe for that. And so that's what this is. So the buyer will typically have the one section, they will have two. But depending on the shipping and all that, we'll talk a little bit about what that means all as we have the shipping and that. But as you can see, they just have one transaction, and they have two. Because in the sale, we have that merchandise sold. Merchandise sold. All right. So Burton Company paid the freight of $150 on July 1st. From Scully Company there. So they're paying this here. We don't have any transaction there. They're paying that freight. And so they again put that in merchandise inventory because they have already, they want to make sure that they have that added on to the cost of what they paid for the merchandise. And then we can reduce our cash. On this one here, Scully Company sold the merchandise on account to Burton. So now they sold some more. This is our cost of merchandise sold, and then again, what they look at there for the Burton Company. And this one, we are now paying delivery expense as if we were Scully. So we have delivery expense of $250 and cash $250. Questions? All right. So the next transaction here is we have a credit memo for merchandise return. So there's $1,000, excuse me, merchandise that was returned to the company. So as you can see here, they again have two transactions because we have to then put that merchandise and receive it back in. So first of all, our sales went down by $1,000, says sales return allowance, and our accounts receivable went down by $1,000 because they don't owe us that money now. And then our merchandise inventory went up by $700, and we reduced our cost of merchandise sold by $700. Because we're bringing that back in, basically reversing what we've done, except with different values. And in here, we owe less money, accounts payable is debited, and then we credit merchandise inventory because we have less merchandise to sell. All right, so Scully Company received payment from Burton Company for purchase on July 5th. So they're only paying that portion of it, only July 5th. So they paid $4,000 here. And so as you can see, we got cash in, we put cash out. You know, crediting it. We're debiting, so we're getting it in. Their accounts receivable went down because they paid it, and their accounts payable went down because they paid it. All right, so Scully Company sold merchandise on account to Burton for $12,000 in terms of FOB shipping points. And these are the terms. And they prepaid the freight for $500. So we prepaid it. So if Scully Company, now we have an extra thing in here. We prepaid it for them. So we have cash that we're taking out for $500, and the accounts receivable went up. So the total for them, they owe us $12,500. And then we have cost of merchandise sold of $7,200, and then we reduce our merchandise inventory of $7,200. And so over here, it was $12,500. And then their accounts payable, that's accounts payable, that's their merchandise inventory they have. All right. So on July 28th, Scully Company received payment for Burton's purchases on July 18th. So we'll just focus in on that one we just had, less the 2% discount because it was due, if we remember correctly, at EOM, which is end of month. You see that's end of month. That's what EOM stands for. So that's when it was due, but they also, within 10 days, if they paid it, so the 28th would be, they get 2% off, and they paid it on the 28th, so they get 2% off. So here, they owed us $12,500, so we paid off that whole debt, We have that discount, and there's the cash. And then for our, if we were Burton, we credit $240 merchandise inventory. So it reduces the cost of our merchandise inventory by crediting that. And then there's the cash that we paid out. So that's the cost of this company here. So does that help you guys see both sides of how it affects each company? All right. So these are the chart of accounts. I'll give you a moment to take a look at those. So you can see merchandise inventory there. All right. I'll leave that up for a few moments, but on page 227, I want you to turn to that page. At the top of the page, you'll see example 5-5. And actually on the bottom of 226 is the beginning of 5-5. So if you look on page 226 there, it says this company sold merchandise to Gray Company on account $11,500, 2% 15 days, net 30. The cost of the merchandise sold is $6,900. The Subvert company issued a credit memo of $900 for merchandise return and later received the amount due within the discount period. So they paid it within the discount period. The cost of merchandise return was $540. So now what we've got to do is journalize these transactions from both sides, what we just looked at. So the first one we'll take a look at here is the Subvert company, and what we'll do there is we have $11,500. We take away the $900 return, which gives us $10,600. That's how much they owe. So that's how much we will have in accounts receivable, right? We then get a 2%, was it 2% discount? 2% discount. That gave us $212, and then we had the rest of it in cash we received. Now, moving on to the other company, the Bray company, we have our accounts payable. We paid them the we owe them $10,600. We have the merchandise inventory, which is our discount, of $212, and then our cash we paid out was $10,388. So as you can see, they all fit together for both sides of that equation. So questions on how that worked? All right. So 247, I want you guys to do PE 5-5A. I'll begin to put the stuff up here for you. questions on that first part? Okay there? Questions on that? That's the way it should look. A lot of these are examples that you'll see in your homework. Let's engage now. Hopefully they're not the exact ones. So that's accounts receivable in AR. That's me shorting it up. That? We're just handling the.
Well, it has on here.
Does it have it on there?
Uh-huh.
Yeah, they just want to journalize the entries for the payment of the due amounts.
Oh, okay.
It's not the actual transaction, so you don't
Okay.
have to. Yeah. Kind of similar to that practice problem we did. That's all it was. But yes, you're right. So the transaction, the first transaction, we can do that. As that sale is done. All right. So a few more pages here. So sales tax, lovely sales tax. So as we well know, that there's sales tax, at least in our state here. If you go a little bit west of here, you don't have that problem, but here we do. We also have something called sales tax payable, because that's not our money. We may be collecting it for somebody else, but it's not our money. I collect that $6 for this transaction, but that's going to the state of Idaho or whatever state that is. So this is what we have to, we must put that in there. So the accounts receivable will be 106. We collect it for that. That's sales tax payable. We pay that when it is due for us to pay that, maybe at the end of the month or whatever it may be we have set. So the state sales tax is similar to what we have here in the state. So 6%. And so on this one here, on a regular basis, the seller pays the taxing authority state the amount of sales tax collected. So this is what we are paying at the end of the, or for the 15th for August. So we're paying $2,900 cash out of that. We were holding that cash for the state of Idaho, let's say. So that's what that is. Okay, so when a wholesaler offers special discounts to certain classes of buyers who order large quantities, these are called trade discounts. So remember that difference there is trade discounts. So questions on sales tax, the pretty simple stuff, those type of things. Okay. So moving forward here, we're now going to look at a multi-step income statement. So we're going to look at a little more complicated income statements. We've looked at just basically revenues and expenses. That's it. Well, now we're going to go into breaking things down in different categories. So it gets a little more complicated, but it's not too bad. So it contains several sections, subsections, and subtotals. So that's what we kind of looked at previously when I first started this chapter. So in here, this is the first part. These are our revenues from sales. We have revenues from sales, less returns and allowances. Oops, go back. Sales discounts. We add these two together, gives us this, and that gives us our total net sales. That is our net sales. As you can see, there are three categories here. There is no debit and credit. We are just organizing the numbers here. That's all this is. So don't think of this as debits and credits right here. Okay? Otherwise you get confused. All right, questions on how that works? So we're taking away sales returns and allowances and sales discounts. All right, so sales in the total amount charged customers for merchandise sold, including cash sales and sales on account. And then we have sales returns allowances granted to the seller to customers for damaged or defective merchandise. And then sales discounts are those are the payments that we've seen before. And then net sales takes away those two things, sales returns and allowances, and sales discounts from the sales. All right. So the cost of merchandise sold is the cost of the merchandise sold to the customers. So the merchandise cost consists of all the costs of acquiring the merchandise and readying it for sale, such as purchasing and freight costs. That's why that merchandise inventory goes up, because that freight cost adds to it. So anything you're preparing that, so if there's something that we do to it, also, we need to add that to it. So maybe it's a special packaging we put on it, because it's our company and that's what we're doing, then we have to add that also to that. We're not going to go that in depth, but that's something that can happen. All right, so this is what it looks like here. So you can see there, we have that first part right here, the net sales, and then we have our cost of merchandise sold right there. And that gives us our gross profits. We kind of looked at that at the beginning of the chapter. And so then what you're going to see here, as we move forward, we'll give you that in just a second here, that's our gross profits. And then we have our expenses, and I'm going to get into that right now. Well, we break our expenses down from selling expenses to administrative expenses. So what does it cost us to sell this? And what does it cost us to basically just our overall business and our operating expenses there? So that's what we're going to take a look at here. So selling expenses are incurred directly in the selling of the merchandise. How we're directly affecting that. So if we look back here, advertising, sales salaries, delivery expense, those type of things go into that. And then these are those again, store supplies used, those type of things. And then obviously the advertising expense is a part of that. And then administrative expenses, or sometimes called general expenses, are incurred in the administration or general business operations. And so these are some of the ones you'll see: office salaries, depreciation of that office equipment, office supplies that are used. Those are some of the things that fall into that category. So now we're just going to break it down into categories, so now we can really read it and see where we're spending our money. That's why we're breaking this down and being a little more picky about everything and put it in those categories. So those are the two there, the operating and administrative expenses. So you can see here, from rent expense, depreciation, insurance expense, office supplies, and miscellaneous administrative expenses. All of those things fit into those categories there. All right. And so then we have income from operation. The operation is also sometimes called operating income. That is basically this is determined by operating expenses from your gross profit. So taking that away. So that just gives you your income from operations. So we take our selling expenses, administrative expenses, add those together, gives us that. This is what we have for our gross profits. That is what we have for our, this is what we have for our expenses. We now have for our operations $77,200. That's what you made. Now then you have your other section here, which goes into other things that you may do. That does not pertain to your normal operations of what you do as a company. And as you can see, there's rent revenue, because we might rent out a portion of our building or another building that we have. But that's not what we do for business. Our business is selling merchandise, whatever it may be. And then we have interest expense as a part of that also. So other income is revenue that other sources are primary outside other than our primary operating activities, like I said. And then other expenses that cannot be traced directly to the normal operations of the business. Again, same thing. Because we want to see how our operation is doing, and we have our other stuff that we can also take a look at. But we want to break those down because if I'm evaluating the company, I want to know specifically what they're doing in certain areas. And so that's what these are right here. All right, an alternative form of the income statement is the single-step income statement, and this is shown in the next slide. So we'll take a look at this one, where it deducts the total of all expenses in one step from the total of all revenues. And so this obviously makes it a little easier. This is a single step, very simple. These are all our revenues. These are all expenses, but they're combined and bunched together, as you can see there. All my selling expenses are put together, so all my administrative expenses. But that doesn't tell me a lot, does it? It just gives me basic information of how the company's doing. We have a net income of $75,000. But it doesn't tell me how I'm doing in these sections here. Where am I putting my money? where are my expenses going? All those type of things. It doesn't tell me a lot. But this is the simple single step income statement, which is a lot easier. So when you see that one, it'd be easy to do. And then we have our statement of retained earnings. Remember that flows into it. So if I go back, this is my net income right here. And there's my net income coming in from that. And I have dividends. So that is my beginning. Take away those the difference there, gives me this. And then I add this to that one, it gives me my new retained earnings at the end of the year. Then the balance sheet, the form of the balance sheet with the assets on the left side and the liabilities on the owner's equity on the right side is called the account form. We'll take a look at that. When the balance sheet is presented in a downward sequence in 3 sections, it has been prepared using the report form. And this is the form used in the next 2 slides. So we saw it, assets, liabilities, owner's equity, right? So now we're going to look at it a little bit different. Well, actually, you probably saw assets, liabilities, owner's equity right here. We're going to see it a little differently here when we have our assets. Now, as you can see, a couple of things, the differences here. Again, these aren't debits and credits. We're organizing the numbers here. We have current assets, and then these are our long-term assets. So anything over a year, plant, property, and equipment. So land, store equipment, those type of things there. Those are more of our long-term assets there. What you'll also see is accumulated depreciation, those contra asset accounts, which are taking away from the value of that. Remember that in chapter 3? We went over that. So that's what these are the contra asset accounts. And then we'll look at the next part here, which is our liabilities. So this is a report form, so it just comes down. The next thing is our current liabilities. Then we have any long-term liabilities, so anything over a year that we may owe on. And so this is the current portion of our notes payable, what's due in the next year. So that is this area here, liabilities. And then we have our stockholders' equity. The retained earnings came over from the retained earnings statements, all right? And fed into here and give us a capital stock plus that, gives us our total equity, which is right there, and total liabilities. And obviously, this number at the bottom should equal the assets that we had on the previous page, which it does. So questions on those, how they all fed? We kind of went over this in chapter 1, a little bit in chapter 3, 4. So it should be becoming familiar. All right, so let's finish up this chapter here and talk and describe the adjusting and closing entry process for the merchandising business. So in here, the merchandising business may experience some loss or inventory due to shoplifting, employee theft, or errors in the recording or counting of inventory. So this is what we call shrinkage. What I talked about a little earlier. Sometimes we don't have what we think we have. And so that's called shrinkage. So it's inventory shrinkage or inventory shortage. Depends on how you want to say it and how your company says it. But a lot of times you'll hear me say shrinkage a lot. So obviously it's larger. What we think we have is less than we really have. So that's the shrinkage there. So you have to make adjustments for that. Because we have some $1,800 shrinkage, we have to make an adjustment in the merchandising inventory. Because I don't have what I thought I had. So my merchandising inventory tells me, well, this should have $63,950. No, you really have $62,150. So we need to make that adjustment of $1,800. So that's what we're going to do right here. So our cost of merchandise sold went up because there's an expense there. We paid for that somewhere. It just disappeared. So there's no transaction of the sale. But what we have is we have to take that and put that in the expenses and how much that comes off of our net sales to help get us to the gross profit. And then we have our merchandise inventory, we'll have less of that because that's what we need to be at. That's what we counted when we have our value. So questions on why we do that adjusting entry there? All right, that kind of goes back to chapter 3. Just a little bit of addition to that. We didn't talk about that there. All right. So debit each temporary account with a credit balance, such as sales, for its balance and credit income summary. So basically going back to what we did in chapter 4, closing out a lot of these things here. So we're totaling all these up. There's our income summary. We credit it because we're debiting all these and zeroing out those accounts, right? So that's what we're doing there, zeroing those out. And then we're going to we'll start over at 0 the next one. And so these are all of our expenses, those type of things. So we're getting rid of our sales returns and allowances, discounts, all of those things there, and expenses all are right here. We're getting rid of all those, closing those out, because these are all debit balances. We're crediting all those by the same amounts to get rid of them, and that's the income summary. The difference between those two is then put into the retained earnings. We add that into the retained earnings section. So that goes into retained earnings. Our income summary then is closed out because now the balance is out. The expenses plus this side equals what we have on the revenue side. And then we have our dividends for the last thing here. So retained earnings then went to dividends. We take away from our retained earnings because I used some of that money to pay my dividends. So the money we made, we paid out to our shareholders. So therefore we have less retained earnings, we pay dividends out. All right, so this is what it looks like here for the income summary. Going back to that chapter 4, we credited it for all the amount of revenues. We took out all the expenses, and then we had our net income, which we moved into retained earnings. So now this thing is 0. And again, we'll start that the next year, start it over, and we'll break that down to 0 again. All right, so questions about chapter 5 so far? We're going to go through the last part here, then we're going to do some more problems. Just a moment. All right. So the ratio of net sales to assets measures how effectively a business is using its assets to generate sales. So this is how we can evaluate how the company is doing in some certain ways. Or do we have lots of buildings, lots of things, and we only generate this amount of sales? Or do we do a lot with what we have? And so we can compare businesses in different industries that way too. So what we do is we take this net sales over the average total assets. Why do we take average total assets? Because things change over the year. And we may buy this building, sell this building, do this, do that. And so we just take an average, starting, ending, divide by 2. And that's how you do the average. So then you take your net sales over that. So this is what we have here, year 1 and year 2. This is Dollar Tree. Obviously, these are probably in millions. They are in millions. So you can see what their sales are. So this is what we had sales. So it's gone up. Year 2 is a lot higher than year 1. This is our beginning, and this is our ending. So as you can see here, at the ending feeds into our beginning of the next year, right? So you can see we've increased some of our assets over the years, and that may be because we bought more stuff, more things that we need, more buildings, or whatever it may be. So let's take a look at both of these here, break it down. So in here, you can see our net sales is higher, our percentage is higher than it was in year 1. And all we were doing is adding these two together, divide by 2 to take the average, right? Ending, beginning and ending, take the average of what those are, and then divide it by our net sales. And so it's 2.52 versus 2.42. So it's increased. So that basically shows us that we're doing better in using our assets. So questions? All right, so let's do a couple problems here. I'm going to start with EX 5-6. That is on page 249. Give you a few moments to kind of look at that problem, kind of walk through it, and then I'll start working on the board here for us. So remember there's an A, B, and C portion of that. The first portion, we bring the merchandise in, we purchase it, we'll return some of the second portion, and the third portion we pay the bill. That's what we're going to do here. first part of the problem, it says that we purchased $60,000 worth of merchandise. So we get merchandise inventory in of $60,000, and then we have accounts payable of $60,000. We owe that money. Crooked here. The next portion, it says that we return some of our merchandise. So I need to subtract from my accounts payable, and that's $12,000. We return it, and then also because I'm returning it, I then have to subtract my merchandise inventory, because I have less of that I have paid for out of that. So I return that out of there. So I'm taking that away by crediting that $12,500. So you can see this. Both of these accounts now should say be about $48,000, right? All right, so that means I gotta pay that account $48,000. Now the discount on there was 2%. Yes, 2%. So my accounts payable is the first thing I'm gonna have, because I need to pay that off. And I used cash to do it, right? So it's $48,000. And then I have discount. And then I have cash. So how much was my discount? $960?
Yeah, but why isn't it merchandise inventory?
Yeah, that's what I was
What did I do here?
very
Right.
wrong.
What's that? Yeah, you're right. It's
That
merchandise
should-
inventory. You're right.
No, it shouldn't be discount, it should be.
Yeah, it should be merchandise. You're right. What's going on? Putting it from the other side. And then, cash. So how much was that, 960?
Yes.
960, and then that gives me 47,040.
Why is it so
What's that?
Why isn't it sales discount for the access?
Because we're taking that away from this one. Because we're taking away from our merchandise inventory. Because we got a discount on that. So
Yeah.
we're taking that away. So we didn't pay that much for it, so we're just pulling it out of that account.
Okay.
So we only paid this amount, really. This is how much we really paid for it. That's included. Questions? All right, let's take a look at 5-12. 5-12 is on the next page, 250. So now we have four things we're going to take a look at here. So it says merchandise is sold on account to a customer for $24,000. Terms are FOB shipping point. 2% off in 10 days, net 30. The seller pays the freight at $425. So the amount for the sale, start writing that down. Amount debited to accounts receivable. Then we need the amount of the discount for early payments. And then it wants the amount due within the discount period. Okay, so you got to break all of those down. Remember the order is you got to do. Pretty much get it to you right there. So I'll give you a moment, then I'll erase this here. We're going to erase this. All right, so the first question asks us, what is gonna go to, how much was the sale? So how much was that sale? 24,000, pretty simple. Tells us that. Then the next one goes to accounts receivable. Well, what goes to accounts receivable? We have the 24,000, right? And then what else goes to that?
The freight.
The freight. How much was the freight?
425.
425. So that will give me 24,425. All right. Questions? So we're adding that to that. So the next question, amount of the discount for early payment. To figure that out, what do I do? So what's the discount there? What do I multiply it against? Remember, it's 2%, 10 days. So what do I multiply the 2% against? This one or this one? 24,000, good. So I take 24,000 times 2%. That should give me 480. Right? Okay. Now, what are they paying?
23,945.
23,
945.
oops, 945. How'd you get that?
Track there.
Yeah, exactly. 24,425 minus 480 equals 28,945. All right. Easy stuff. You guys got this chapter? You'll have a couple other problems that are a little more in depth than this. These are some of the basic questions that you'll have. There's one problem, or maybe two, that takes a lot of the things that we've done, put them all together, which will answer questions like that. So this is probably pretty much the basics of what you'll have for chapter 5. So do I have any questions on chapter 5? No questions, huh?
That's all relevant.
Yeah, say that again on Wednesday.